What's up, everybody? So today I sat down to talk with my good friend, Krisitn Stark. She is a loan officer here in Texas, and she is my absolute unwavering go-to when it comes to anything mortgages, especially in this insane financial climate we have these days. She is extremely knowledgeable. She's got a lifetime's worth of experience. We call each other all the time to bounce ideas off one another, try and get creative for our mutual clients to help them out, help them get through this process. It's not always easy and straightforward. So we wanted to sit down today to talk about marriage, separation, divorce, and even self-employment income, and how those things might impact not just your tax return, but also your mortgage qualification opportunities, and what might hold you back and what might, give you a leg up on this thing. So I'm going to drop Kristin's information down below in the description in case you want to reach out to her. Maybe you're getting ready to apply for a mortgage, or you want to know what you need in order to be ready in the future. So she'll be there for you. And as always, DM me, let me know what questions you have about what you heard here today, or if there's anything you'd want to hear in the future from me or someone you'd want me to speak to. With that being said, please like, subscribe, share, and let's get right into my conversation with Kristin. Hey, Kristin. So we met through a mutual friend, Jen, who's a realtor, and you are now my mortgage lender that I turn to for everything that I need. And I hope that you turn to me for everything you need with taxes. So for those who don't know, that's how we met. That's what we do. Kristin is a mortgage lender. I'm a tax preparer, amongst other things. And we wanted to talk today about how marriage and divorce impact taxes, how self-employment income and the way you report it and what you do with it impacts taxes as well. And then maybe throw a few nuggets at our followers in the end of, what they should look out for and what they should do.
Right? All in the nuggets.
All in the nuggets. Okay, so I think you probably had a question for me first.
Yes, so divorce has been the topic of my year. I don't think I've ever processed so many divorces, but a lot of times I get to people before they are divorced. A lot of people don't know how to file their taxes, right? They're still technically married as they're going through the divorce. So in really your best opinion, if someone is about to go through a divorce, how would you suggest they file their tax returns? Or is that specific to their situation?
So when it comes to the tax side of things, it's always specific to the situation, because even before you start going through a divorce, you always have the option to file separately. So what I always do for my clients, for example, is I prepare the tax return both ways. I prepare it if they're filing jointly. We see what the result is, how much money is being left in the household at the end of the day. And then we prepare it separately. And then if there's kids involved, we do the right things for them. And the rule for kids is who provides more than 50% of the support for the child, that's who gets to claim them. There are other caveats that come into play when there's children involved in terms of other filing statuses, but that's for another time. Anyway, the point being that you can always file separately. Once the divorce is finalized, the IRS always goes by December 31st. What's your status on December 31st? Are you still married or are you divorced? If you're divorced, you're going to file as single or head of the household if you have your children that you're claiming. So that's what the filing is going to be like. When it comes to the mortgage side, though, I think that's more of your ballpark. And that's what you want to talk about, what's looking better, or does it even make a difference?
Yes. So, really, my follow-up question to that would be say I have someone on the phone, right? She's about to go through a divorce. She's about to file her tax returns. And she's just a straight up W-2 employee, no children, right? How should she file her tax returns? And why would she file it either married separate or just full-blown separate? What's the differences between the two, and how do they each affect her in this situation?
Right. So, well, again, I don't think that for a mortgage, it's going to make much of a difference. Again, from the stuff that I know about this, again, if she's on a W-2, I don't think that part matters too much for the filing status, whether she's on a W-2 or 1099 or not working at all, and just trying to claim those child tax credits. And then as far as claiming the children, I would think that from a mortgage perspective, when you are claiming children, there's maybe more allowances for you or something that you could add back. I don't know.
Not really. I was just asking because a lot of people ask me this question, and then of course I have to text you. So more of a little bit of one of those nuggets to tie back in, that just to give people some brief information on that just before they come to me. They'll now know it socially.
So how about this? The rule of thumb should be file the right way. So,
love it.
Right. So if it's just you're single, file as single. Don't try to claim someone else's children.
Okay.
If you have kids, file as whatever the status should be. Sometimes it's head of the household if the kids live with you, or if you have some sort of divorce agreement, but you are the one providing the support for the children, then you may be able to file as head of the household. And for those who don't really understand, head of the household is just a better filing status than single in terms of the deductions that you get from the IRS.
Is there a standard deduction?
Exactly. So the standard deduction is one thing for single people, one thing for those who file as head of household, and another for those who file married separately or married jointly. So that also, it kind of plays into what your decision is going to be. But when it comes to filing status, it's really about what's the right thing. Did you have kids? Did you support the kids? Yes, head of household. If not, and that. If the only other thing to know is that if you are married and you choose to file separately, but you live together, you cannot, nobody can claim head of the household status, even though it would give you better deductions. So that's one thing you're not allowed to do. And they will catch you on that. That's an easy one for the IRS. Other than that, again, file the way you're supposed to. And it doesn't matter if you're just a statutory employee or self-employed.
Yeah. Well, I mean, that's perfect. I mean, because divorce definitely affects a mortgage, right? As far as taxes go, you know, it's who's getting the house, it's who's getting the assets, it's breaking down all of that stuff, which is for an attorney. But as far as like people that just need our help, that was the best answer I think I could have gotten.
Yeah. And I think at the end of the day, the answer is it doesn't matter if 2, 3, or 5 people are applying for a mortgage. It's what's the debt to income, right? And that's what's going to get it for you. So if for some reason you don't want to or can't be listed on that mortgage, but your partner or whoever it is has the income to show to get the mortgage to qualify for it, you're good to go, right? It shouldn't matter. It comes down to who is on title of the home when it comes to ownership and things like that. Because I think there could be a misconception that people feel like if they're not listed on a mortgage, somehow that removes them from any entitlement to the property at all.
Yeah, but we're in Texas. Sorry, Texas, y'all.
Which, for those who don't understand, it's a community property state, which means that no matter what you do, you share everything anyway. So good luck.
Meaning that if you're on the note or not on the note, your spouse is they can get half. Just throwing it out there.
Yeah. Another good one to throw out at people.
Yes.
And then I think just to tie back into filing status is another thing people should know is what does a mortgage do for your tax return, right? So most people know the basics, which is that, if I secure a mortgage, if I pay property taxes, I get extra deductions. And it's not always the case. So
I'm curious. Why?
So yeah, it's a great question. So here's what happens. Anybody who files as a resident of the United States, doesn't matter if you're a citizen or a green card holder. If you're just a resident of the United States, you have a social security number, you receive something called a standard deduction on your tax return. So whether you're W-2 or self-employed, say you made $100,000 last year, you file as single, you get a particular standard deduction, which reduces your income before figuring how much income tax you should have paid on that income throughout the year.
So stand by. I just want to make sure and get clear. So you're saying you make $100,000 and there's a standard deduction that gets subtracted, so then you're being taxed on your income.
On the remaining amount. Yeah. Amongst what other deductions you might have, once your tax is figured based on that bottom line number, then whatever tax credits you get, like child tax credit, for example, or a solar tax credit, will reduce the tax amount directly. And then that's what you should have paid throughout the year. That gets pushed up against what you actually paid either through your regular W-2, your paychecks, or if you're self-employed and paying estimated taxes. And then the difference is what you owe or what you get as a refund. Now, every filing status is going to have a different standard deduction amount. Just so you know, and it goes up. So if you're head of the household, it means you have more people living with you, you're going to get a higher standard deduction. If you're married filing jointly, there's 2 of you, so you're going to get a higher standard deduction than a single person, which all completely makes sense and checks out. Where the mortgage, property taxes, these types of things come to play is there's something else called itemized deductions.
Yes.
Right. So itemized deductions are made up of a few things. Generally, what you think of is medical expense.
Now, hold on just one second, just because I want to clarify. Itemization can be done for W-2 or self-employed.
Anybody who files a tax return.
Perfect. Just sorry. I want everyone to know.
Yeah. And some people are required to, and I'll get into that as well. So anybody who files a tax return is given the standard deduction and has the opportunity to itemize their deductions. Itemized deductions are made up of, generally speaking, medical expenses that exceed 10% of your income. So just the amount that exceeds the 10% portion, meaning if you made $100,000, only the amount that exceeds $10,000 will be deductible. That is added to a combination of state income taxes paid if you're in an income taxed state, and property taxes capped at $10,000. So you add state income tax plus your property taxes, but 10K is the cap. So if you go over that 10K, that's added to the medical expense. And then your mortgage interest paid on mortgages currently up to $750,000.
Okay, I want to highlight that though, because this is a big, big thing. Lots of people buy houses way over 750. So can you break that down for all those people that buy over 750, what that truly means?
Right. So when you buy a house, let's just say you bought a $1.5 million house, you put a 20% down payment, and then you have a mortgage of a little over $1 million remaining on it. We basically prorate the amount, the interest paid on that entire mortgage amount as a proportion of what it would have been if the mortgage was $750,000, and we continue to deduct it that way. If your mortgage is $750,000 or less, you just get to do that.
You could.
And on mortgages that were secured prior to 2016, that cap is $1 million instead of $750,000.
That's actually really good to know. So before 2016, this was a law that was enacted essentially, or I guess a tax law that was enacted.
Exactly.
Okay.
It was part of Trump's Tax Cuts and Jobs Act on that this came up, as with that 10K cap on the property tax and the state income taxes, which is called the SALT cap.
Wow. Okay. I'm even learning new stuff today. I love this.
And then the only other thing that's an itemized deduction generally is gifts to charity.
Okay.
And it must be an accredited 501c3 charity. You don't need to show proof of that up front as with everything else, but you want to have it.
501c3, just for the general public. What does that mean? Are you talking about like Goodwill or like a charity that has accreditations?
So they are registered with the IRS. 501c3 is a section of the tax code.
Gotcha.
They'll be registered with the IRS. It's a simple Google search. The IRS has a listing of all the charities that are accredited. So common misconception with these is GoFundMes. Because anyone can make a GoFundMe. Something, God forbid, happens to my family today. I need some help with the surgery. I go on GoFundMe, I create one.
Absolutely.
But I did not get accredited with the IRS as a nonprofit. And so if you donate money to me, that's not a deduction for you on your taxes. So
It's just niceness.
yeah, it's
A
just
little bit of niceness.
sometimes you just got to be kind and not get anything back for it. That's
You and I know that more than
Yes.
anyone else, I think.
I think so. So when you aggregate all those itemized deductions, the medical expenses, the state and local income taxes, property taxes, mortgage interest that gives to charity, if that amount exceeds the standard deduction, then you're already getting, we use that instead, not in addition to, but instead of the standard deduction. And it helps you. It reduces your original income by more, so your tax is going to be less.
Okay.
So what happens with mortgages oftentimes is people are very happy-go-lucky on getting a mortgage or going to get some help. And at the end of the day, they're in a place where maybe property taxes are super low. They're in a state that does not have state income tax, so they're not getting much for that part of
Texas.
the deduction.
Texas specifically here. Yeah.
And then they did a gift to charity, and they have a small mortgage. They have a mortgage on email, let's say $250,000 or $300,000. Their mortgage interest for that year and their property taxes might not be enough to exceed the standard deduction, which right now is close to $14,000 for a single filer. The standard deduction.
Huge.
Huge.
Can you say that one more time just for those in the back? Because that is huge.
The standard deduction today is about $14,000. And for a married couple filing jointly, it's double that. So it's about $28,000. If you're over 65, you get a little bit extra. You get another $1,500. If you're blind, you get a little bit extra. So legally blind. So you got to take that into consideration, because oftentimes when people are getting ready to buy a house, they'll ask someone like me, what's this going to do for my taxes? And those are the people who are really trying to get prepared. There are those who just assume they're going to get something. They go and buy a house, and then they're shocked when nothing happened with their tax transfer, because people are relying on a tax break to be able to afford their mortgage. They think they might save $5,000 or $10,000 a year, which could be a big hit to your mortgage bill.
Well, one thing I hear a lot, and I really want you to add some light to this, is these high interest rates don't matter because I get to write all of this off. So when someone says that, they get a form at the end of the year, beginning of the year, that basically shows you the interest you've been paid. So say we get a $20,000 1098. What does that do?
So that's going to go into that. Well, first of all, we're going to see what size the mortgage was, right? If it's 750 or over, we're going to, let's say it was below. And today's rates, realistically, 20K in interest is definitely for a mortgage smaller than 750,000, or probably like a third of that.
Unfortunately.
So that's going to go into that calculation for whether you can itemize or not. So let's say you had $20,000 in mortgage interest on a house where you pay $5,000 a year in property taxes. You don't have any state income tax because you live in Texas or Florida or one of these states. So that's $25,000 altogether.
Okay.
And you're a single filer. Your standard deduction is $14,000. Your itemized deductions are $25,000. Automatically, we're going to say, yes, itemized deductions, thank you very much. So now for that 100K a year earner, instead of only reducing that 100K by 14,000, you now get to reduce it by 25,000. And that's going to save you money on your tax return. So again, very
But
important.
it's not just a, hey, you owe $20,000 and I have $20,000 in interest in a straight, simple subtraction equation here. Because I do believe that a lot of people really do think that.
I see what you're trying to get away to say. That's an important point. Yes.
Yes.
Tax deductions versus tax credits.
Yes.
Right. So anything that's a deduction is going to reduce your income before we figure what tax is charged on that income. So 100K income minus a $20,000 deduction means you're taxed on 80K.
Sounds right.
Tax credits would say, okay, I have a child. They are a $3,000 tax credit for the child tax credit. And my tax on my $80,000 of income was, let's just say $10,000. The $10,000 in tax you should have paid is reduced by $3,000. A credit goes against the tax directly that you're supposed to pay.
I feel like we need to make a color by numbers chart of this because I just truly feel like people don't understand this as well as they should.
Yeah, I guess we would both know about people who don't understand this. Yeah, I would say you might hear about it more because I'm always trying to educate my clients so they
Same.
I know I try not to even give them a chance to screw this one up. So they kind of know. Mine are well trained, I would say. But yeah, no, it's definitely a common misconception. So it's important to remember. So anything that has to do with your mortgage is going to be a deduction. It's not going to be a tax credit.
I love that.
Something that could have to do with your house that would be a tax credit. And I mean, we're talking about mortgages, but I'm sure there's people involved in real estate that or have their own primary homes that are listening. Something that it could be a tax credit is going to be if you install solar on your house.
Okay.
There's a federal tax credit there may be state tax credits as well. If you have to change out your boiler, your water heater. So certain energy improvement properties will have a tax credit. So that's really going to help your bottom line. Oftentimes, maybe not so often, but I see this happen from time to time. Someone has a really large tax bill for the year. Maybe they had some sort of large bonus at work or whatever the case may be. They will install solar on their home by taking a loan for the solar, knowing that the full cost of that solar is going to work towards a tax credit for them. So they might spend $90,000 on solar on a note from the solar company, but a 30% tax credit will mean they get 30K roughly against their tax bill. So that happens a lot. And it's a strategy to consider for sure, especially if you've been considering going solar anyway.
Yeah, true. Now, is there an income bracket that you no longer qualify for credits?
It would depend on the credit. They're all different. It's tough to get into. Honestly, I don't have the numbers off the top of my head.
No worries. It's just, I noticed that like higher income brackets don't get near. You don't get the child credit. You don't get there's so many things that you don't get once you hit that, like, it seems to be 400,000 sort of range, right? Like,
yeah, so there's a few that are common. Child tax credit is one common one for higher income earners. Educational tax credits is a big one. We have not seen them adjust for inflation in a long time, which is a pain, especially when you have all this talk about, forgiving student loans and trying to help our students and all that. educational tax credits phase out at $90,000 for a single earner and $880,000 for married earners. And again, these days with inflation, there are quite a few households that are sending their children to schools where they're paying for school. They're not getting assistance, financial assistance, but they also make just too much to be able to claim those tax credits, which could be very significant. They could be thousands of dollars. Very important. In my family, we went through that. There are ways to adjust for these things. You really need a good tax, not just preparer, but a tax planner for these types of things to understand how you can reduce your income on paper. You still get that income, but reduce it on paper to qualify for these things. So like contributing to retirement plans, maybe a little bit more in one year than in another year, would be just one example of that. So that's, yeah, it is a good point that a lot of people phase out of these.
And that's
credits.
something that I feel like it's very important to highlight because, when we're talking about credits and deductions and stuff like that, it's not that hard for two people in a family to get to 180K.
No.
It's really not. I mean, the cost of living has adjusted. Our salaries have somewhat adjusted, but hitting 180K isn't near as hard as it used to be.
Yeah, absolutely. I mean, and there are a lot of households that are just married household, but it's single earner, and that one person will make more than that and just to have no help on that front. And again, a lot of these things have not been adjusted for inflation or to help those higher earners, but still might need the help. They're taking care of a lot of people, whatever it may be. Yeah, and that's another thing. It has nothing to do with how many dependents you have in your house, because you might be like dual income, no kids, dinks, right? Who keep all their money.
Remember the days.
Or you could be someone who has 5 kids and your cost of you might be making $300,000 or $400,000 a year, but you got nothing left behind it after all the activities and feeding and putting a roof over people's heads. And
You can't write off feeding?
nope,
Management of children, no? Okay.
you should be able to.
I agree.
Your 3 or 4 dogs.
Exactly. Okay, so the next thing I was kind of thinking about talking, were you wanting to add anything?
No.
You don't think? Okay, should I be listed on a mortgage? So I have a lot of people that, come to me married. One person doesn't earn, one person does. Should they be listed on the note? Or does it matter in your opinion? Because to me, it's a community property state, right? They're both on title. But if they're on the mortgage or not, it doesn't really matter to me as much.
Yeah, so kind of in my field, kind of like a gray-ish area in that I'll explain. It has to do back with the filing statuses and deductions for the mortgage. Right. So just to tie this back in, when your status is married filing separately, and like I said, anyone who is married can file jointly or separately, and you could flip-flop year to year if you wanted to. I always do whatever is going to keep most money in the household. But let's say someone actually is in the process of getting separated or divorced. They're not living together anymore. Maybe they're not even very amicable and talking to each other about things. When you have a married filing separately status, if one person itemizes, the other person must itemize. So let's say you're not on the mortgage, you're not paying the mortgage, you have no claim to it, and your ex is itemizing their deductions. If you were on the mortgage, you would split that mortgage interest down the middle. You'd each claim your own piece. But when you're not on the mortgage and you're not helping to pay any of it, you're not getting to claim any of it, you might have just lost all your deductions. It took you from, the married filing joint standard deduction to the single standard deduction to having to itemize but having nothing to itemize, right? So that could be something that's painful. So I think that might be one reason that you want to be on a mortgage. Probably a good one.
I think that's a great one. Well, let's see. Should we go on to household finances?
Before you do it, do you have any input on like from your perspective, what you've seen?
I mean, it just honestly depends, right? Because a lot of times I have buyers that one of them just does not qualify, right? Or the spouse that doesn't work also has a lot of the debt. So I want to remove her immediately. Or him, really.
Sure.
But I was just curious from your perspective. To me, they're going to be on title no matter what.
What about people who have commitment issues?
You mean like you?
No, I mean people who are like, we're getting ready to move in together. How about we're not married yet, but we're moving in together and we want to buy a house. And at the end of the day, if this guy or this gal that decides not to marry me, and they're going to have the claim to, like, what do I have claim to if I'm not on the mortgage? And you know?
Those are always some fun conversations to have. I have them daily. So, I have a guy that's earning all the money. The girl, she earns like a lot less, right? They're a girlfriend, boyfriend. They want to move into a home together. And I just have to explain to them, like, if you're both on the note, then you're both responsible for it. If you both qualify, then why not be on it? Then you've got split responsibility. If you're not married and there's only one of you, you're on the deed, but you're not on the note. So you can stop paying.
Yeah.
And it doesn't have any ramification on you whatsoever unless the boyfriend or girlfriend default on the loan.
Yeah. So, basically you want both people on it. Don't let anybody manipulate you to not be on there, essentially.
Exactly. If you both qualify, there's absolutely no reason not to. You know what I mean? Unless there's just some sort of commitment issues happening, which there's a lot of commitment issues that happen. And then they'll ask me if I should put the boyfriend or girlfriend on title. Well, a lot of times title won't do that.
Right.
So even if you're engaged, you're going to have to wait until you're married, and then you're going to have to put yourself on the deed.
Yeah, and I think that depends on what state you're in also,
Yes, it
probably,
does.
right? So, we're talking about Texas here,
Texas
just to be clear.
specifically is very strict.
Yeah.
So
Gotcha. Okay. And it's the same way, like with the other way, right?
Yes.
If you're in the process of getting a divorce and you don't want to have anything involved from the person you're divorcing from, you might get sucked into having to provide some information.
So there's the way to process a mortgage in divorce is one of three ways, really, right? Like, it's amicable. They know it's going to be a long divorce. So honestly, it's one spouse on it. They're going to be on the deed, both of them, right? This is an amicable situation. They both stay on the deed after their divorce is final. They do a quick claim deed to remove whichever partner in the divorce is vacating ownership in the house. And then you have another kind of people that you absolutely need the divorce to be final before you close so that they will not be on title. Because let's be real, 90% of the divorces are messy.
Yeah.
They hate each other. I'm literally trying to just get any line of communication out of both parties so that I can get the thing closed. So if you're doing that, then, you should be divorced. The divorce should be final. Everything should be divided as such, everything. And then we close, and that is your home without any ramifications from your spouse.
Yeah, I just feel like we deal with clients all the time. I'm sure you and I do, that they're going through something, they have something burning a fire under them to just go buy something now and not wait the 6 months or the year that it's going to take to get through this. Hopefully it's done that quickly. Yeah. Sometimes it's not, and they're just like, but also they don't want to listen to you and give you the stuff you're asking for. And then someone like you will turn to someone like me and be like, hey, I need the information, blah, blah, blah. And now I have like conflict of interest issues. One person doesn't want to talk to me or the other, or like, it's a whole freaking mess. Always.
It's always a mess. But clear lines of communication whenever you're processing any sort of divorce, this is going to be in your field, my field, anyone's field. It's just be completely open and honest. Like, if you buy this house before you're divorced, and all of a sudden you guys get in a huge fight, guess what? They can ask for 50% of it legally.
Yeah.
Because you made a choice to, sign this deed, sign this mortgage with them being on title. So it's an unfortunate reality that I have seen, tank. Really.
And now we've entered the marriage counseling section.
It really is. I feel like I'm half therapist a lot of the times, but just as a general rule of thumb, kind of like you were explaining the deductions, be divorced before you go buy yourself a new home. Truly, just sever the ties. And it's a lot less messy, and you'll have a lot less headaches, really.
Yeah. And you'll cause less headaches for us too, which will make us do better for you.
So then we'd be bored. I don't know if
I'll find other things to do, always.
I don't do clean. I do sometimes, but mostly don't do that,
I think that's good on that, but I wanted to touch on that part of it. I think it's important. And then I guess we have the question of, this also comes to divorces and married couples, of being in the know on household finances.
Yes.
And we're not giving financial advice or anything here, but it does intertwine with what we do. So I was starting to tell you the story earlier. Like, I have a client who, he was married. They're much older people. He's in his 80s now. His wife passed away. His wife passed away years ago, and she took care of all finances in the house. She spoke with the accountants. She took care of the bank accounts. She paid the mortgage. All of these things she did. When she passed, suddenly, he did not know his left from his right hand. He did not know what to do with these stars. And again, older people, they don't have many friends left oftentimes. They don't have people to turn to. They lived in a place where their kids weren't with them. So anyway, it turned into him asking one accountant for advice, one financial advisor for advice, people taking advantage of him for money because they saw they had some money stashed away after all these years of working, and 401ks, and it's awful. It's awful. It's awful. And then he finally landed on me. And so I think the lesson to take away here is that, fine, you don't want to deal with it. I understand. Have some sort of idea. And I understand that marriages are all different and the dynamic is different. Like I have clients who are like, tell us exactly what part of my tax bill was from me and what part of my tax bill was for my wife and the other way around. And then they'll split it at the end of the day. Fine. Have your finances separate. At least know the basics.
Yeah.
Know if there's a retirement account, know if there's a life insurance policy, know if there's a trust, know if there's a mortgage, who the mortgage is with, which bank do you go to, because if God forbid, and it doesn't have to be death, it could be severe disability or cognitive disability, whatever it is, you're going to have a really, really hard time. And there are going to be people that take advantage of you and milk you for a lot of money that you work hard for. So again, it's not financial advice, but it's kind of like life advice and things that we deal with all the time.
Well, we deal with the ramifications of it, right? Like your guy is coming to you, God knows what has happened in the time since his wife has died. I also help a lot of elderly people that have just been taken advantage of. And I have to fundamentally rebuild them and just be so direct and so honest with them because all they've been told is lies.
Then you have to work through those trust issues too.
Yes, exactly. And it's just, I love that. Like, so, as an example, once you buy a house, or even now actually, have a binder with every bit of information in it for your spouse, for yourself, for whomever, might come along after you pass away, just to make things a lot easier on yourself.
Yeah. I'm single and I have this. Like I have a folder in the computer that has all the important information. It's like through a bunch of levels of security. It'd be impossible to get it if you didn't know the exact steps. And my parents know how to get it. That's it. Like, so, and everybody should, whether it's in a safe that's like fireproof and waterproof and etc., or it's in the cloud somewhere, hopefully protected.
Mine's in a safe. Yours is in the cloud.
Got some stuff in the safe too.
You need an army tank to get through it, but
My golden retriever to protect it.
Oh, that's true. He'd love it.
But yes, it's important. And again, it's not that you're going through this, is the mess that's caused afterwards, and you end up paying more money to unravel all of that. Yeah.
And that's the hard part, especially when a lot of elderly people are living on stated income, very fixed income. So it's never a lot. Even the people that I talk to that have done all the right things, it's never higher than $8,000 a month with everything. So
yeah, and look, to some people that is a lot. And by the way, just because you don't make a lot doesn't mean that you can't still be taken advantage of. They'll still find a way.
Oh my God, they will find a way. High, low, it doesn't matter.
Absolutely. All right. I'm satisfied with talking.
Excited about this next section though.
Yeah, self-employment. All right, let's hop into self-employment.
Are you ready to dance with the devil?
Let's hit deductions first. So a lot of self-employed people out there spend their entire day on TikTok and seeing all these various tax schemes and scams or realities that you can use to benefit your situation. Oftentimes, especially in small business, which is who we deal with, we're not dealing with like big corporations really. In small business, when you're starting out, you're a startup, you are going to look for every edge that you can get in order to keep some money in your pocket or be able to reinvest into your business or whatever the case is. Really. And also in small business, more often than not, everything ties into your personal tax return. So when someone's coming to you to apply, hopefully, for a pre-approval for a mortgage, you start looking into things and they have a business that's bringing in $500,000 a year or $1 million a year. And then you look at it and you say, wait, but that bottom line number says $15,000. So where did this all
bottom
go?
line number? Okay, so let's dive into that first, because I do have clients that come to me and say they made $1 million, right? Which that line, what is that line where you're looking at that $1 million versus the line that is the profit and loss line?
Right.
Because people will always tell me this line when this line is the line that matters, which is the profit and loss. What did you claim after all deductions? So I am so curious.
Yes. Exactly, because they're going to say to you, like, Yeah, but I had my car, which could be a business expense. And there's this travel I went on, which most of it was for business. I went to a conference, but then, I saw that you can schedule some personal time around that conference if you want to, and it's still a business expense, and the list goes on, right? So off that $1 million, they had $900,000 in deductions, $300,000 of which could have been deemed personal expenses and not been a business deduction, and their bottom line would go from 100 to 400K overnight, just like that. And they probably qualify for whatever loan they're looking to get. Right?
That's a beautiful scenario in which it doesn't exist in my life. I'm just kidding. There are some people.
Some people who play by the book.
Yes.
Or again, planning, because they'll come to you and you'll tell them, yeah, but you can't take it out now. Like, I know the car is for you, but I can't add it back in, or whatever it is, the food or the travel, or the insurance. But if they knew this a year ago or 2 years ago, even if they were doing this then, they could start edging in the right direction and reorganizing some of their expenses, still doing everything legitimately as they have been, but just reorganizing how some of those expenses happen, whether they're related to the business or not. And so they can start to cushion their income. Yeah.
Because I love where this is, but I also want to let people know. So if you're just starting a business, we do require 2 years of tax returns. But if you have an established business of 5 years or more, we only have to really get 1 year. So this could be when you said strategy and planning, right? You don't have to claim it all the time. But if you're planning on buying a house, or you think you're going to buy a house in 2025, then you do want to make sure you talk to a tax professional about how to itemize that so you have enough usable income. So I'll let you expand from there, but I just wanted to break that piece down because the planning on that is huge.
That's important. Also, to tie into planning, a lot of people whose businesses have that type of revenue, they will try to buy a heavy piece of equipment or get a big property, get a big write-off all up front or most up front to reduce their tax burden, which for tax out of pocket is a great idea. But then for when it comes to getting a home for yourself, it's not such a great idea. Planning comes into play. So oftentimes in business, people will be told, hey, it's December, you have this much profit. Like an accountant will tell them this, you have this much profit. Go buy the new computers you need for the office. You're ready for a new truck for work. Get a new truck for work now, just so we can take this bonus depreciation and depreciate most of it today. And you have a big expense on your books.
I wish they said that. They say blow it.
A lot of people say that.
They say blow it.
Yeah. Does your son need a new iPad? Does your daughter need this? Does your cousin need that? And
it's misinformation, though. It really is. And I mean, like, I love that I have you sitting in front of me, because that is what I hear from most self-employed people.
Yeah. And by the way, 99% of the time, they're not even business expenses. You went and bought gifts for people that you can't write off, right?
100%.
Yeah.
So at least line laterally with the truth on that, y'all.
Exactly. So to my point, sometimes let's just talk about like the legitimate scenarios. You'll be told to go spend money on stuff you were going to buy next year anyway, now because you had a really good year, take that deduction. But if you know you're going to buy a house, maybe just wait 2 months. Instead of buying in December, buy in February or March after you've closed on your home. And, it's like the cost of doing business, basically, right? Like opportunity cost, that's the word I was looking for, of being able to buy your home with a nice low mortgage rate, or being able to buy your home with a nice fat mortgage rate, or not being able to buy it at all.
Yeah.
So that's the other thing. So let's say business is not in business for 5 years in good standing. They don't have 2 years of good history. There's another option, right?
There is.
What's that?
I mean, you go the non-traditional route, essentially. And that just means, okay, so a lot of times I'll have self-employed people call me. Now they're very dead set. There's no changing their mind. They know that they don't want a traditional loan and they don't want to pay taxes. Usually don't like show me any documentation either, but that's fine. So at this point, I'm like, okay, you're a non-qualified mortgage, which means you do not follow Fannie or Freddie or FHA, VA, USDA guidelines, right? You don't make sense to them. So now you have to make sense on this other pool of lending, which basically means you can go several different ways. The first way I always go with people that I can see make a lot of money is a bank statement route, right? You can do a 24-month bank statement. You can do a 12-month bank statement. Basically, I take 24 months, average them together, and build your baseline income for a month, right? That's how I get your month. Now, this is where you have to talk to people that are self-employed and balance that, right? Because non-traditional mortgage lending also comes with a cost. There's usually a 1.5 to 2% fee just to do the non-qualified mortgage. And the percentage rates are at least 1% higher, right? So you take that cost and you calculate how much that's going to amortize, right? Versus how much you're going to pay in taxes if you were to claim enough to go traditional. I mean, 9 times out of 10, man, it makes sense to go bank statement if you have the 20 to 10% down.
Right.
But
You're cool with all those other fees.
yeah. I mean, you have to be okay with those fees. But at the same time, when I'm talking to someone who's already deducting absolutely everything, they're okay with outside lending parameters because they just don't want to pay the tax man.
Right. Or they already did what they did, but they need to buy that house
They
today.
need to. And I mean, people will do anything for it. And I'm just like, okay, well, there are other options, right? There isn't just the one size fits all. I do a ton of bank statement loans. So bank statement loans are a very viable option for people that just do not want to pay the IRS a lot of money or just have a lot of deductions in general. So that's usually the route that I go. There's also like people that go from being a W-2 employee to 1099. That's a non-qualified mortgage when you do that. Can I count that 1099 income instantly? Yes. But 1% higher, the parameters change. When you don't fit into Fannie and Freddie's box, the parameters change. My job as a lender is to just be as crystal clear with what those parameters are expanding to make sure that they have all the information to make either A choice or B choice. File your tax returns correctly without deductions. Well, not any deductions, but the proper deductions. Right. Or let's go bank statement. I mean, in my field, that's really what options you have if you're a self-employed person.
Sure. Yeah. I think it comes down to also, so I know myself these days don't want to stay in one like apartment or house for too long. So I might make a different decision knowing that I might be in my house for 5 years versus someone who's buying a forever home, right? In terms of that interest and what I'm going to do to impact that interest rate and et cetera. So I think that's something to consider as well. Like try to count it up over time.
Yeah. And then you can amortize it to see if it makes sense. However, everyone keeps telling me it's their forever home as well. And then 3 years later, I get a phone call. The people mostly stay in their homes 3 to 5 years. Yeah. I mean, as an average, it's 3 to 5 years. So no matter how much we think forever is, that's this version of ourselves, who our version in 3 to 5 years says, this is nothing. I want more.
Yeah. Times are different now, though. I hear that boomers don't want to sell their houses because it's too expensive to buy a new one.
Well, now boomers are never going to sell their houses. And I think people are going to die with their 2.99. So, I mean, I think there could be ghosts haunting their house. It could be in the middle of a gang war and they still aren't selling because they don't want to pay, 6 to 7% interest, unfortunately. That is our reality right now.
Yeah.
And you just beam them?
I can't. But at the same time, if you have 2 or 3 kids in a 2-bedroom house, it's going to come a point where either you get a tent in the backyard or you get a bigger house. Yeah, exactly. So, I mean, I feel such empathy for those people that are stuck, but at the same time, you have a 2.99 interest rate. So come on.
Yeah. So just to kind of recap, generally for self-employed people, it's either traditional route.
Yep.
One of 2 ways, right? Like either you have 2 years or you've had business that's in good standing, making good money for 5 years, and then you use 1 year of income, or they're going to the bank statement loans. Generally, that's like the 2 or 3 that you're using, right? Yeah, that sounds like it's been my experience. So that sounds about right.
Well, one more little thing. I have a P&L program as well, which is basically we go off of a P&L.
Yes, P&L. This is something I wanted to talk about. I have qualms with this stuff. And it's not just P&L, it's what lenders do today a lot. And lenders, just to be clear, not being you. It's the banks, the underwriters behind this. Underwriters is who I should have said. All the time, I'm sure you've heard me complain about this before. All the time I get a request, hey, can you just sign off with an accountant letter saying that, oh, this P&L is true, or that this tax return is true, or if they secure this mortgage, it's not going to negatively impact their business. So they end up going under and the business goes under and then they can't pay their mortgage and blah, blah, blah. And these underwriters, these lenders, whoever is behind this nonsense is constantly looking for another party to drop blame on. And you tell them, we call this, I don't know if it's a real term, but we accountants call this comfort letters. That's what we call them. You're trying to make the underwriters more comfortable. There's a lot of accountants out there who are just like super by the book. They're very straight edge. They won't even hear this nonsense, right? And they don't care if they're going to lose their client over or whatever. I'm kind of in between. If it's a very, very low risk and I'm assessing my own risk, not that I'm necessarily qualified to do that, but just as a human, I'm assessing my own risk and it's super low risk, I will do this. If not, I will fight with the lenders. I'll let them know I think they're crazy. I will throw like legal stuff that I found or that's been provided to me at them. Not that I'm an attorney, but just again, from my own human perspective. And our insurance doesn't cover us for this type of stuff. Like our errors and emissions insurance, our liability insurance does not cover us for this type of thing. So it blows my mind. But P&L, self-employed individuals, that's where this stuff usually comes into play. It is so, I just dealt with one yesterday. It's so frustrating. And they give us attitude like, oh, who do you think you are to say no? And I don't want to lose my clients. And business clients oftentimes are the ones who refer you to you the most and can impact your reputation in either direction the most because they already have a platform to talk about things. So it pisses me off. And sorry, one more thing. While I'm on this rant, one more thing with the P&Ls is if you find a shady enough accountant, you can write up whatever freaking P&L you want to.
Agreed.
There's nothing to check that. And from what I understand, at least what history has shown so far is once that bank accepts the mortgage, they're not going back next year to check your tax return to see if you actually filed the information that you provided to them, right? So I think that that's something that's going to impact our industry as well.
Yeah.
Going forward.
I mean, me personally, I've only utilized that product a couple of times because like you, it needs to make 100% sense, right? Like in my case, it would be like 22, they did terrible, but 21, they were great. It was just a fluke year, right? So I wouldn't have a very good average of 24 months, but the P&L, I only want to use the P&L essentially because his business is now back. He has a track record of doing great. He had a fluke year for whatever reason, and it makes sense in this situation. I usually go bank statement no matter what because it has a better interest rate.
Right.
The riskier the product, the worse the interest rate. I mean, I can do bridge loans. I can do DSCR loans. I can do cash flow loans. But when you start getting riskier, I mean, you're going to pay more interest rate. You're going to pay fees. That's just the cost of doing business.
So many people are willing to do it. How many people are sitting on cash that they don't want to disclose how they got it or whatever the case is?
Which is not our concern, right? Like to me, I'm like, okay, you don't tell me however you got it, whatever, but here's what I do need from you, right? Like I see in your bank account, so I'm gonna have to source it.
Yeah.
So, and I need it to be a verified source, which then in case sometimes you come into play, and this is the part of us that makes you angry because you're completely right about the P&Ls. Like we want plausible deniability.
Yeah.
Because we not only want plausible deniability, but we want to make sure the loan doesn't get bought back. Me personally, I truly want to make sure that my clients are okay. I want a CPA to tell me that this isn't going to impact their business. And if it is, I want them to say so. Because I don't want to put them in a product that's not going to make sense. Maybe we need to look for a bridge loan at this point.
That's another reason, by the way, that I think this is nonsense, because when I first started to get requested for these letters, so I'm not a CPA, I'm an EA, right? I'm an enrolled agent. I'm licensed to practice taxes, all 50 states. I can represent people in IRS courts. I cannot audit financial statements. I can't do these things. And at first, they always said CPA letter. Now, all of a sudden, and these banks are crazy. They have forms pre-written for this with the bank letterhead and all this crazy stuff they're asking for. And now it says you're a CPA or your enrolled agent or your advisor or your accountant or your brother. Like it'll say, I will show you one later that I got yesterday. It was very, very crazy. This was in Pennsylvania, I want to say.
Oh my God.
Or maybe Georgia, one of those, Pennsylvania or Georgia.
Do you think it's just desperation in this market just seeping in?
I just don't understand what the banks are trying to do after that. I mean, these days, I mean, compared to getting a loan, I think I got my first house loan in 2021. It was very straightforward. It was still very straightforward and simple. The rates were great, et cetera. Yeah. Today, it's like the FBI is investigating you for every little thing. And I know it's the underwriters and whatever guidelines that they're given by whoever. But yeah, it is. And again, it frustrates the client. It frustrates your client, and oftentimes their friends or whoever. I mean, I consider a lot of my clients my friends because just like you, we deal with everyone personally, right? We don't have other people dealing the whole way through with your client. So I have a very personal relationship with everyone. And I feel I'm always the bearer of bad news, you know? Like,
You and me both.
yeah, that's how I feel because of these things. Whatever. That's my rant. That's what I wanted to say about
Hey,
P&Ls.
I don't do them a lot. I only do them whenever I feel like my client truly understands what he's asking me to do. But I am the kind of lender that's very, very honest. So, I mean, unfortunately, to my demise, a lot of times I lose a lot of business because I am so honest, because I think there's a better way forward. It might not be right now. It might be in 6 months to do it the right way, to make sure you get the better loan, right? You might have to wait 6 months, but then you pay 2% less interest, don't have 2% fees.
Huge.
And as long as your taxes aren't that devastating, why not go the traditional route? Unless you just have some sort of vendetta against the IRS, which I think they do. They really, really do.
Right. Okay. Enough on that.
Enough of our rant.
Yeah. So I think one last point that we wanted to touch on is at one point should people start using a tax preparer? And the real question is, when do I switch from TurboTax or the volunteer income tax assistance program to a tax preparer? And it's not an easy answer to give because at this point where I've gotten with my business, I actually turn people the other way. I do tell them like, hey, your return is easy enough that you should just use TurboTax. You don't need to pay me my fee, or I'll go pro bono for some people when it comes down to it.
Who are those people though? Who are those people that, what would you deem someone who should go to TurboTax or H&R Block?
You have a W-2, you maybe have a mortgage for your primary home. Usually you're just a renter. Okay. If you have kids, there's nothing crazy with them. Just they're your kids and that's it. Like the most simple form
Is there an
of being a
estimate
human.
though?
It has nothing to do. You could be a $300,000.
So it doesn't matter. Income is not. Okay. Gotcha.
When it comes to preparing your taxes. Now you can go prepare your taxes somewhere and then turn to a financial planner or a tax planner to help you with the rest. Because if you are the higher income earner, this is a good thing to talk about too. I'm glad we mentioned this. So I tell this to my clients all the time. It's not financial advice, but kind of also like how I view life. Take care of yourself before you take care of your kids in terms of when it comes to preparing for your retirement versus putting into a college fund for your kid, for example, because you're going to get older before they are, and you don't want them to have to take care of you. So deal with your retirement stuff first, then do the rest. Deal with your life insurance first, then do the rest, right? Like if you have a home that has a mortgage on it, God forbid something happens to you, you don't want your kids to lose that home. They can't afford to work yet, or they don't have a job where they can afford to pay your mortgage. Have a life insurance policy for that, or for your spouse. Maybe if it's a stay-at-home dad or a stay-at-home mom, or whatever the case is with that. So life insurance is important. Retirement planning is very important, even if you're putting $100 a month, but you're starting at 20 years old or 30 years old. So that planning is important. And for those reasons, if you're making a type of salary where you're not completely paycheck to paycheck, only paying for necessities, when you have some money to spare, you want to talk to a planner to plan these things. Now, what I see often is people are like, my job provides a 401k. I contribute, 2, 3, 4, 5% of my income to that 401k. Everything's good. 401k has a manager, there's fund managers. But then some of my clients, I'll offer them, I offer this to everyone, but some of them will ask me to do it. Like, hey, can you just go in and take a look at where the money is actually being invested and what it's costing me? I cannot tell you the amount of times that I've had someone getting 5% returns on their investment, but paying a 5% fee to the fund.
That happens often.
Very often, too often. Even once is too often.
Yeah.
Look, there's predatory systems everywhere, and this is one of those.
So they
places.
build it in to show you some sort of rate of return, but not enough to show their fee.
Yeah, the rate of return is real. Like your money is sitting there, it's invested in the market or a particular stock or a set of stocks, whatever, and it is growing by that much. But then there's always a fund manager because your money is usually invested in a fund, whether it's like a targeted retirement fund, meaning it increases its risk or decreases its risk aversion as time goes on and you get closer to retirement. Okay. It's invested in multiple stocks at the same time. All of these funds will have managers, and those managers got to get paid. And some funds, so like your traditional Vanguard funds or Fidelity funds, these like big institutional funds, they'll have super low fees. You'll see like 0.02%, 0.05% of your holdings in that fund. The more predatory ones will have a 5% fee, an 8% fee, a 10% fee. And you can end up either breaking even on your money or losing money. Why did you put it in there to begin with? You could have done all this stuff yourself.
Well, that's the thing. A lot of people don't know how to do it themselves. It's so intimidating, so they just don't. They keep kicking the can. So in a lot of cases, some people would have no money invested if they didn't trust this predatory person. And I hate that it's that way. But I personally, contribute to Vanguard myself because I understand it. But so many people don't, right? Like even investing just in an S&P on Acorns or Robinhood is better than it sounds like going to someone and potentially paying a 5% fee.
If you end up in that situation.
Wow.
Exactly.
That's crazy.
This being to the point of maybe you don't need a tax preparer. Maybe you can do everything yourself on TurboTax for free or for $50 or $80. I'm not sure how much they charge now. But sometimes a tax preparer will find that thing that where you went wrong that has nothing to do with filing your tax return. So you're paying for peace of mind. I think that's the important part. So anybody can go file by themselves. Majority, I make decent money off of people who come to me from TurboTax, because it's usually a mess.
Yeah.
Sometimes I'll send them there, but I'll tell them like, these are the forms you have to file, go take care. If you can't, come back to me, I'll help you out. So really your most basic, it's usually going to be, early, late teens, maybe early 20s who are working a simple job, trying to make it through and live by themselves. They rent where they're living, like that simple person can
Standard.
Yeah. Anybody up for other people who don't feel like they can afford tax repair. So this is where I learned a lot of what I know. When I started, I did an internship. It was called the Volunteer Income Tax Assistance Program that is funded by the IRS. So there's centers everywhere. They're usually associated with a college or a university. And this is a center where if you make below a certain amount of money, they will prepare your tax return for free. So at the time I was doing this a little over 10 years ago, it was, I think, $65,000 was the cutoff. A lot of people made that type of money or less. Your retirees who just have to file their Social Security income, or
some don't even have to file whenever you're just on Social Security income.
Exactly. That's another thing to also for kind of like a nugget is there are a lot of people who don't have to file who should file.
Yeah.
It's not really your Social Security earners, but it is your like lower income earners. Again, usually students who worked in the summer or working like 1 day a week throughout the year. You're going to receive your pay stubs. They will take a little bit of income tax out, but your income is not going to be high enough that you have to file. A poor tax preparer is going to tell the parent, like, you don't need to file this, don't even worry about it. A good tax preparer will say, hey, to the parent, you're filing your tax returns with me. Your kid has a very simple return to file. Let me just do it for you for free because they've had $300 or $400 taken out in income tax, and we'll get that back for them. For a $500,000 household, that might not mean much, but for that kid who wants to go, buy shoes or take someone out to dinner, that's going to mean a lot. So that's another thing too.
Well, and a lot of things with like elderly people that have just Social Security, what I've noticed is they also have houses that are paid off, or they might have rental, and they might have people renting them, but they're not filing tax returns. So when they come to me, I now have to, yes, they own the house, but they still have to pay property taxes, HOA, and home insurance that I have to count against them. And on a fixed income, that becomes a problem because they haven't filed their tax returns, and you have to have some sort of rental history or a really good explanation why you're just now getting a lease after owning a home and not living in it for a while.
And look, you could always go back and file those tax returns. You're able to. You won't always get. Another thing about tax returns, you could go back as far as you want to file your return. You won't always be able to get your refund. But in a situation like that, I don't know if that also maybe.
Well, I mean, I am having to. A lot of times, especially with fixed income, I have to make sure that they have usable income to offset. And mind you, a lot of these people are putting hundreds of thousands of dollars down. We're not talking about big mortgages here, but even that small amount isn't enough with just a $1,400 to $1,600 income per month.
Yeah.
So taxes are very important. So when to start for me, I wish I would have talked to someone like you when I was 25. Because I feel like I would have been in a lot better position, because a lot of people do go and file their standards. I just had a married couple that each filed married jointly, but individually somehow through H&R Block. And that's horrible because now I have to have them amend this. You know what I mean? And they need to pay more taxes. They had no idea. They were just trying to do the best they could because they were traditional on paper. Yeah. So you also have to take out the element of this isn't what people do for a living. They don't do taxes. They don't do lending. So, what seems so simple to us can be very difficult to the average person that doesn't have this thought process. So, I mean, for me, I think, yeah, you were right, 100%. Early 20s, teens, H&R Block, that's a great place to start. But as you start to get into your career and your life, it's so advantageous to hire someone like you or anyone who has any experience to make sure they're going down the right path.
Yeah, 100%. I think also something to take away is you need professionals in your life. So like if you're going to buy a house, you probably need the realtor. You definitely need the mortgage lender. You probably want to speak to your tax accountant. And if you're a high income earner, you want to speak to your financial planner as well. So it's important to have all these people in your corner. The realtor you don't have to pay for. They only get paid if they sell. The mortgage.
Well, you might have to pay them.
Oh, well, sorry. The rules have changed.
The rules have changed just a touch.
Okay. All right. Bully your realtor into not taking fees up front.
I know. It hasn't been a problem yet.
Your lender is going to do their best for you or try to because they're only going to get paid if the place sells. Hey guys, so apparently the pull-out game on the charging cable from my camera is super strong today, and we died out for like the last 10 seconds of that episode and did not realize it. But I did just want to wrap it up for you, and what you heard was pretty much it. You want to be surrounded by professionals always, especially as you begin to generate more investments, more, quote unquote disposable income. And when it comes to real estate, your realtor, your mortgage broker, your lender, your tax preparer, accountant, and your financial planners or advisors, those are very, very key people to you in making sure that you get the best deal possible. Get advised if you're making some bad decisions or might be making some bad decisions because, those emotional decisions happen all the time. And again, with the realtor right now, things have changed a little bit, but try to make a situation where unless they secure the thing for you, they're not getting paid. The lender already knows they're not getting paid if they don't secure the deal for you. Your tax preparer is already, hey buddy, your tax preparer is already getting paid if you're working with them. And the same thing goes for your financial planner or advisor. So make sure that you leverage their knowledge and expertise as much as you can. That's it for this one. Please, like, subscribe, share this video. I'm sure a lot of people can learn from it. And as I said in the beginning, please reach out with any questions that you have for myself or Krisitn. Till next time.